there's all this noise, but you need to keep your focus on the long term. You need to manage towards not what happens in the day-to-day, but the long-term thing. So if you really understand that, there are factors out there that are social, environmental, that are material to your business, and you need to be addressing them, then you have to stay focused on the long term and not get caught up in the day-to-day, even though there are distractions, and they're probably only going to increase.
Welcome to the Future in Sound podcast. I'm your host, Jen Wilson. This is a podcast where we talk about prioritizing people, planet, and profit in business strategy and decision making. We'll have different names for this: ESG strategy, sustainability strategy, maybe integrated strategy. Whatever glossy terms you choose, if you're in the thick of this stuff, you know there's no silver bullet. Like in any strategy, you can't prioritize everything, so there are trade-offs and different views to consider. In this podcast, we learn from world-leading experts who share bits of wisdom that can help us see the future we want and our role in it. This isn't a normal business podcast. We're not interested in the latest trend, jargon, or branding technique. Instead, we go beyond the headlines and look to clarify our long-term view on resilient economies, competitive business strategies, and decision-making best practice. This is episode 6, Resilience. Quick story. In 2007, in northern Italy next to the picturesque and serene Lake Como, a group of philanthropists, entrepreneurs, investors, and policy experts were huddled around whiteboards at the Italian villa. The group had been convened at the Rockefeller Foundation's Bellagio Center to identify ways of attracting private capital to help solve social and environmental problems without necessarily forfeiting financial returns. The result of this debate was the coining of a new term that has since become mainstream. The term, impact investing, has since been used to describe investments with broader social, environmental, and financial goals. My guest today, Saadia Madsbjerg, recounts this story and captures the landscape of sustainable and impact investing in a book she recently co-authored with Judith Rodin. The book is called Making Money Moral: How a New Wave of Visionaries is Linking Purpose and Profit. Saadia is a global leader in the field of sustainable and impact investing. She's a former managing director of the Rockefeller Foundation, where she led the foundation's financial innovation program to channel money from the capital markets towards sustainable development. Prior to this, she held senior positions on the strategy team for Cisco Systems and as a management consultant with McKinsey. She's a recognized thought leader and has contributed to publications including Harvard Business Review, Foreign Affairs, and the Financial Times. Saadia, I'm delighted to have you on the Future in Sound podcast. Welcome.
Thank you so much for inviting me on the show. It's great to be here.
Let's start with your journey. You've had a multifaceted career with leadership roles in private, public, and philanthropic sectors. How's this shaped how you wrote your book?
So, Jen, when I started my career, which is a little over 2 decades ago, the role of the private sector, the philanthropic sector, and the public sector hardly overlapped. Like, the roles were so sharp and the boundaries were so clear, and they each had a unique role in society to play. And what happened was, on the business side, the primary focus was to create wealth. And you did that for your shareholders. And you did that in a way where you focused on the bottom line. And it was, it's the shareholder primacy mantra that we've all been hearing about for a really, really long time. And whenever the social or environmental questions came into the conversation, we call them externalities. And we said, well, that is not the responsibility of businesses, and that's not the responsibility of investors that invest in those businesses. So the ideology was there was the wealth creation that was on one side, and then there was the distribution that was the primary focus on governments and nonprofits and philanthropies. And the moral side, where we looked at social and environmental factors, happened on the distribution side. Now, what has happened through the course of my career, as I've kind of moved from the public to the private to philanthropic, is that those sectors have converged. And there has been an understanding that purpose and profit are linked. And what we used to call externalities aren't externalities. These are real risks that have an impact on the bottom line. And in certain cases, these are real growth opportunities for businesses and for investors as well. So the boundaries blurred. Some people talk about a convergence. I would still say that, there are specific roles for businesses and nonprofits and philanthropic institutions that are distinct. But we all just realize that we all have to work together. And having been a part of all three different sectors and having an understanding of the development and the context and how these different organizations work or institutions work, it's helped me in the journey along the way. There's a chapter in the book, which is actually the first chapter, called Capitalism Changes Course. And in that chapter, Judy and we try to kind of show what that trajectory has been, like what that movement has been and what the key influences have been over the course of the last decade or two that has led us to the change that we've seen.
And as you see these boundaries blurring as you've described it, one of the topics that you've commented on extensively is the importance of actually harnessing the power of wider markets to focus on social and environmental challenges. Can you tell us a little bit more about why this is so critical given the challenges we face?
So I think we can look at it from a societal point of view, and then we can look at it from a business point of view. If we look at it from a societal point of view, we as a global community, and when I say we, I use that term very loosely, came together in 2015 and said, we all want to sign up for something called the Sustainable Development Goals. It is a framework for what we want the world to look like. It's goals that we collectively want to work towards, and that goes the whole span from addressing climate change to poverty to equality to so many different things. The conversation that also happened around that time was climate change in particular. So the same year, 2015, we had the Paris Climate Agreement that was ratified. With both of these big policy frameworks, there was the question of how are we going to pay for it? Like, who is going to foot the bill? Because we all know that it is going to cost a lot of money. And the conversations that happened in the philanthropic community and in the public institutions at that point was, no matter how we twist and turn it, there isn't enough money in philanthropic budgets or in public budgets to actually achieve these goals. So what do we do? The initial conversation was around, well, we have to find ways of engaging the private sector. And there were many meetings that were put together with a lot of investors that were brought to the table as well, institutional investors, pension funds, sovereign wealth funds. And the conversation actually went kind of round and round in circles, where they said, well, we need you guys to be part of it. And on the investment community, the answer was, well, we have a responsibility to the people that own this money, and we have a responsibility to shareholders. So yes, we will go and help invest in some of these programs and projects where it meets our risk return criteria. Right? But the question of how do you get to the point where you have programs and projects that both deliver something that's good for society, but at the same time also deliver an attractive financial return? What really changed the conversation was the research and the data that was coming out on the investment side that showed these are not two separate things. In the long term, if investors want to create value for the people that they administer the funds on behalf of, you have to think about sustainability factors. If you don't think about them, there's both a risk to your portfolio, so the value of it can decrease, Plus, you're going to lose out on great growth and return opportunities that you could be tapping into if you were looking at it more broadly. So it's important from a societal point of view because we have these ambitions and we have these goals and we have to figure out how to get the money. Otherwise, it's just a pipe dream. But it's also really important from a broader financial markets point of view, because if we want integrity, if we want value creation over the long term, then these factors have to be built into the decision making and into the portfolios.
Mm-hmm. And one of the things that you cover in the book is that, we're seeing significant pressure from asset owners like pension funds that are saying, we have a long-term time horizon. We're interested in how our investments perform, not just in the next quarter, the next year, but the next, 50 years kind of thing. And I'm wondering, as you look at the landscape of pressure and the landscape of response to that pressure, so those who are actually managing the money, we're seeing about 1 in 3, as you say, dollars in assets under management calling themselves environmental, social, governance-related funds. How can we tell between the leaders in this space who are really, they've got those sustainability factors down versus those that maybe are at the beginning of their journey in this regard?
So, Jen, maybe I'll also take this opportunity to just expand a little bit on what you said in terms of the asset owners that have really stepped up to the plate and said, we want to make sure that the money is invested in a different way, and it's about long-term value creation. One of the cases that I think is deeply fascinating to look at, which has had a massive impact on how business is being done now and been a big, big push when it comes to ESG investing, has been the story of GPIF. So the Government Pension Investment Fund, which is the largest pension fund in the world, is the Japanese pension fund. They have over $1 trillion in assets under management. And it was around 2005 that this started undergoing a strategic reform. Now, the reason for that wasn't so much saying, let's look at the world and, let's figure out how to do something good for society. It was because they looked at the Japanese society and the challenges of an aging population. And they had one of those big moments where they said, we need to change some of the basic institutions we have that will make sure that there is value in, and money to take care of the aging population that we have in place. And that means taking a look at our pension fund, and that means investing differently, because it's not just about the commitments that we have for, the next 5 years or 10 years. We really need to be taking a long-term view and make sure that it matches the needs we have as a society. And that was really, you had philanthropy, and you mentioned Bellagio starting a conversation around how you could do this type of investing. But you also had big reforms that happened similar to what happened in Japan that all came together to the point where you said, okay, now we have 1 in 3 dollars that are invested using a sustainability lens. Your question around how do we make sure that there's integrity? How do we make sure that there's real impact and not just somebody putting a nice label on a fund without doing anything differently? It's a really valid concern. And as we look at, people talk about how do you bring it into the mainstream? I think, 1 in 3, you are part of the mainstream. Now the question is, how do you make sure that you don't squander what you are doing, the opportunity? And how do you make sure that when you get to 2 in 3 dollars invested, that you also start seeing the impact, and we don't find ourselves in a position 10 years from now where we say, oh goodness, we should have done more to make sure that the impact was real because now we're behind. I think a lot of it is a lot of philanthropies, a lot of public institutions have tried to come up with frameworks and standards to help guide the market towards real impact. But I think given where we are now, if we want to make sure that it's done well, what we need is more and clear regulation. Mm-hmm. You need clear regulation when it comes to taxonomy. So what does it mean when we're talking about green? We shouldn't leave it up to every single asset manager to come up with their own definition and then put it out into the marketplace. Also, clear regulation when it comes to disclosures. So as a business, if you say that, you have achieved net zero in your operations, like, what does it mean? How do you make sure that you can remove all the distortions that currently are in the marketplace? Because it is a little bit of the Wild West where anyone can get up and come up with their own thing. I mean, I think the positive news is that there's been a massive push when it comes to this types of regulation in the European Union. And that is kind of the leading standard we have right now. I think there's a lot of interesting conversations that are happening here in the US, and the SEC has gone in and started taking an interest in it. So we need to get that right if we want to make sure that we not only have the money invested in a way where we make ourselves feel good, but where we have it invested where we actually see the impact as well.
That's a great point. And related for the audience, the EU taxonomy does things like looking at the percentage of revenue that's coming from greener sources. So if you're an auto manufacturer, what percentage of your revenue is coming from electric vehicles versus internal combustion engines, just to give a bit more granularity around how green is green. And related to that point, I'm interested in data and data gaps. You mentioned disclosures. It strikes me that a lot of the data that investors might use to make decisions around ESG are process related rather than outcomes related. And you talk about measuring impact in your book. And I'd love to just get a bit more detail on how we can think a little bit more about the impact versus the process. So an example would be, if I'm a company that's looking to get to carbon neutral, I can maybe offset some of the carbon emissions that I have, versus net zero, where it's about, I want to eliminate my carbon from my operations. They're two very different ambitions. One is looking at outcomes, the other is looking at process. So Saadia, from your perspective, how can we start to look a bit more at outcomes with data?
So I think there are two big challenges in the data kind of world. One has to do with what data you're using, right? So process versus outcomes. The other has to do with the frameworks or how you're doing the assessment with that data, right? And we have a quote in the book somewhere as well, which is, data is the easy part, analysis is even the easy part. Like, it's about how you get to the so whats that are relevant. I mean, that was a big term we used to use in my consulting days. It was all about the so whats. Otherwise, you could just get lost in everything that you were looking at. So I think it both has to do with the methodology, but then it also has to do with what types of data you're looking at in the process. One of the interviews that we had done for the book is with the CEO of State Street Global Advisors. And, we asked about challenges that they were facing, and that's one of the biggest asset managers in the world. And he pointed to what he calls the data disarray. There is a lot you need to sift through just in terms of getting it in, but then also how you apply it. So you're looking at outcomes and how you apply it. So, in a world where I always used to say this when I was still at the Rockefeller Foundation, and people would say, well, it's been 10 years. Do you think you have achieved the goals that you set out to as a foundation? And I said, the problem is the goalpost moved. Right? In 2007, we had a view of what needed to get done, but the world changed. And as the world changed, the goalpost moved as well. And I think you find a little bit the same here with, your example around net zero. Well, 5 years from now, when we talk about climate, diversity, the biodiversity, for example, is going to be a big part of the equation. It's not just going to be about greenhouse gas emissions. That's where it is now, but it's going to change because we know that the two are linked. So far, we've been going down a path of just looking at greenhouse gas emissions as success. But if we don't figure out how to also measure and monitor impacts on biodiversity, we may find ourselves in a position where we actually didn't have the results we wanted to have. So that doesn't exactly answer your question, but I think it does highlight the continuous innovation and need for new thinking that we need to have in place on the data side, and when it comes to methodologies and measurements as well. One last thing perhaps also to mention here is that 10 years ago, right, when you talked about ESG frameworks and measurement or impact, you could almost imagine like a checklist where you said, do you have a policy in place for X? And you could, either check yes or you check no. Today, you're in a different place, but we have to make sure that it's not static. It's not backward looking. You can't go in and make assessments on what companies were doing last year when so much is changing so quickly. So how do you figure out ways of bringing in information that's up to date? Like, how do you leverage all the technology that's now available out there to make sure that the information that you're basing your decisions on is up to date and not something that was the case a year ago? Because we all know how much the world has changed just in a single year.
Absolutely. Speaking of change, I wanted to ask if you would mind illustrating what you mean by resilience, because I think that concept is one that you brought out in the book and would be very interesting to listeners.
So maybe also I'll take a step back where we talk about resilience in the context of investing, just resilience more broadly. That was one of the big focus areas that the Rockefeller Foundation had in terms of its programmatic efforts. So I joined the foundation back in 2013. And at that point, the term was new to me, I have to admit. And it was a steep learning curve, but at the end of it, having sifted through all of the documents and all of the work that the foundation had been doing, it came down to something that's quite simple. It was about building the capacity for individuals, for communities, for societies to withstand and bounce back from shocks and stresses. So it's kind of saying terrible things happen in the world, right? Just last year, COVID-19 has been devastating for individuals, for communities, for societies in so many different ways, from economic impact to impact on education to health impacts. So it's about putting in place solutions and processes that allow you to bounce back from those situations so that you don't go to, a worse place. But understanding that terrible things happen, and that could be COVID-19, but it could be the weather-related disasters as well. And as we built the portfolio around impact investing and around finance, we tried to embed the thinking of resilience into it as well, and said, well, what are the places where we can go and help put in place solutions that would help those sectors or those societies handle the challenges better, bounce back from them better as well. I'll give a specific example so it doesn't get too theoretical. But there's something we funded which was called the Forest Resilience Bond. And it was very much focused on the big, terrible challenge that California has been facing for a very, very long time when it comes to wildfires. They happen year after year. The intensity has gone worse. The impact on the communities has gotten worse over time as well. Now, in one scenario, and you have a lot of different nonprofits and philanthropies and charities doing this, and it's needed, you go in and help with the needs that arise after the disaster has happened. But what we tried to understand was what is causing those fires to get worse every year. Like, are there solutions that we can invest in and put in place that would alleviate those problems, like really address those root causes? And one of the things, and there are many contributing factors, but one of the factors had to do with the health of the forest and the forest maintenance. So over the course of decades, we've had a policy where not enough money has gone towards maintaining what's called a healthy forest. And right now, where the public budgets are, it's just not possible to take money away from fighting the fires to actually going in and doing all of these preemptive things that would make the situation better over time. So the idea was, can we put together a financial instrument that would raise money from private investors that could then be used in collaboration with the US Forest Service and with people that actually do this for a living and know how to go in and put in place all of these different solutions and channel the money to those programs. So the forest restoration work is done. That, one, reduces the risk of the fire, but two, also leads to improved quality of water in the area. I mean, these ecosystems are all linked and related, right? You can't separate the quality of the water from other things that happen. So if you then have those positive impacts, there would be a flow of cash or money that goes towards repaying these investors. So again, kind of this idea of let's go in early and figure out how to address the root cause, as opposed to waiting till things have happened and then just try to put Band-Aids on it. So that's one example. I mean, one thing maybe I should also add in the context is with Rockefeller Foundation, especially if you dig into some of the early letters that program officers used to write to each other. This is like 100 years ago, right? And we have the foundation has an amazing archive center where you can go and read a lot of this, and it's available online as well. The foundation from the early days had a very specific focus on addressing root causes, and it was about scientific philanthropy, and it was about not going in later, but really understanding what those problems are. And I have deep respect for that way of thinking and working. I think what I realized through my years at the foundation is you also have to have someone who can go in and help with what's just called humanitarian these days, because that need is there, that need is real. When terrible things have happened, you can't turn to those societies and communities and say, no, we're working on the root causes. So this isn't part of the, we can't put resources to work here. So it's about the entire community coming together and somebody working on the root causes and then somebody working on the immediate needs, because you really need both sources of capital. It's not enough to just be doing one.
It's a balance. It's a really powerful example as well, looking at the ecosystems that can be set up to reduce the risk of wildfire. I remember in 2010, I was studying the corporate response to the Haiti earthquake. And that was the first time that I came across this Build Back Better kind of sentiment, philosophy. And one of the examples that I came across, devastating, but mudslides were a cause of significant loss of life. So a community next to a slope that did not have enough growth on the slope in order to prevent mudslide. And the idea was, okay, well, if we're going to invest in preventing loss of life in the horrible event that there was, another earthquake, well, it probably makes sense to look at an environmental solution. And I think that one of the things that was really interesting in thinking through how we look at that investment in terms of a return, sometimes when we invest in preventing disaster, we can only see the impact in preventing catastrophe, and we only have one world. So we can't perfectly compare our world to a control sample. And I'm wondering, when you think about how to measure the impact of some of these interventions, how does that work? How do you know how many losses that you've prevented, and how can that be translated into, yes, we've had an impact, or no, we haven't had an impact?
So my candid answer to that is there is no scientific way of getting it completely accurate. Right? There are lots of ways of going in and trying to build models that say, this is what the system looks like. There's a lot of, conversation around systems thinking and understanding the interdependencies between, health, economy, nature, for example, the problems, figuring out what the intervention is. And then related to that, when you then say, okay, so what does success look like? How do we know if we've achieved what we were supposed to achieve? Sometimes you get it right and sometimes you get it wrong. I mean, one of the examples that left an impression on me, or things that I read, it was around the Millennium Development Goals, right? So before Sustainable Development Goals, the world had Millennium Development Goals. It was smaller scope, also mostly focused on low income countries or middle income countries, and less about Europe and the US and the more developed part of the world. And there was a focus at one point which had to do with education, not early childhood, but elementary education and so on. And there's money that was poured into it, and it went in and tried to measure what was happening with education outcomes. And you didn't see the big shift that you thought there would be. And why is that? It is because it wasn't just about what is happening in the classroom. There was like the health and the sanitation environment that surrounded these communities, the schools where the kids lived, meant that they were suffering from health conditions that had to do with poor sanitation, which meant that you could get them into the classroom, you could put the resources into the classroom, but in terms of their ability to learn when they were in the classroom, that was impaired. So it's understanding the linkages between different challenges, between different sectors. It's difficult. And I always think of it as it's a long journey of learning. You think you have a view of what the world looks like till you learn something more, and then you build it out, and then you build it out, and you try to do better, and you try to do better.
In a way, what you're describing is also a resilient mindset. You know, one of the things that you comment in the book, you talk about the importance of nimbleness. And it's almost that nimbleness of mind that allows us to continually renew how we're viewing information and make the best decisions we can. Linked to that, I guess it's a bit of your McKinsey hat that I'd love to draw on for a moment. One of the things that struck me when I was a management consultant was strategy seems to be the selection of, pursuing a few things or focusing on a few things to maximize the speed at which you achieve particular goals. And those can be financial goals, those can be employee-related goals, customer-related goals, environmental, etc. And in a way, working within organizations, usually it takes some time from the time that you say, yes, this is a priority, to, well, here's an outcome, even if you're only looking within the organization. And then you have, so that's sort of the strategy mindset. And then you have the resilient mindset, which is also, well, we constantly have to be renewing our view. We need to take on board new pieces of information. We need to make sure that we're up to date. How do we balance the need to sort of focus and stay the course so we have an impact with the need to constantly be nimble, take on board new pieces of information?
There's a real tension there. And I think that tension is just growing stronger over time as we learn more about how all of these different things are related. When I joined the Rockefeller Foundation, I think one of the things that I found deeply humbling was we can take in all of the information we have, and we can, I could help shape different programs, but whether they were going to be successful or not, I probably wouldn't be there to find out. I wouldn't be there the day some big event happens that shows that, that thing that I helped grant fund and I helped design or structure had actually had the impact that we were thinking of. I mean, when I was there, we would talk about things that the foundation had done 10 years ago, 20 years ago, 50 years ago, or even 100 years ago, right? And we pointed to those as this is the role of philanthropy. This is what philanthropy at its best looks like. So that's, the first part of what you described, which is like, it takes time. It really, really takes time. And if you're looking for instant results and instant gratification in some sense from the job that you have, then you're going to be disappointed. Either you're going to be disappointed or you're going to end up self-selecting things that probably aren't the most important ones, and you're going to leave the really challenging things on the side because you want to see results sooner. But at the same time, if we've, say any program, didn't have to be any of the ones I started, you've started it, you've put it in place, and then you get new information. What do? Do you go and change the program, or do you stay the course, which is as you described? I think there are ways of changing programs where you still have a commitment to the underlying thing you were trying to achieve, right? You have to have some flexibility, some nimbleness built into it, but you also have to have steady nerves as well, where you say, I can't change what I'm doing every 6 months or every year because I have a commitment to the organizations on the ground that are doing the work. And you kind of figure it out from program to program. I think the bigger challenge is what happens when new issues and challenges come up that are not related to the program, which happens all the time in philanthropy, right? You have focus on one thing and then something else terrible happens in the world. How do you then figure out how to stay the course on what you have started instead of saying now something else is more important and I need to stop this and I need to start doing something else?
How does this look within the corporate sector? So you've worked for Cisco, you've advised via McKinsey a variety of different, with a variety of different clients, I should say. How is this balance then struck within a corporation between nimbleness, do you think, around the latest ESG? Sometimes I see, I get notifications in my email saying the ESG theme of this week is XYZ. And I think to myself, wow, it's a weekly update that would be very difficult to incorporate into strategy versus, okay, here are our pillars on ESG. This is where we're going to lead, have sort of a steadfast approach. How do you think we can get within the corporate sector the right balance?
So I saw this chart not too long ago that had an overview of the financial market, so S&P 500, what has happened over the course of the last year. And it really caught my attention because there were so many ups and downs on that chart where the message was it's so easy to get caught up in the day-to-day noise, and there's a lot of noise, right? And you could be leading a big company and there would be noise related to sustainability points, but also other things as well. But the whole point of it was there's all this noise, but you need to keep your focus on the long term. You need to manage towards not what happens in the day-to-day, but the long-term thing. So if you have deep focus on sustainability, if you really understand that, there are factors out there that are social, environmental, that are material to your business, and you need to be addressing them, and you treat them the same way you would do any other strategy effort, and you put in place a plan which is just like the others, then you have to stay focused on the long term and not get caught up in the day-to-day, even though there are distractions, and they're probably only going to increase. I think one of the big challenges that doesn't get discussed so often is not everything that is important from a societal point of view is important to the bottom line of companies, even in this day and age, right? And not everything that's important to, wherever we live is going to have an impact on the investment returns of funds, even with a very long-term view. So how do you filter through that? How do you, as a business leader or as an investment manager or as an asset owner, figure out what are the things you bring into your investment portfolio and into your realm of doing business, and what are the things that still are the responsibility of, public institutions? And that too, there's more and more research on that topic that makes it possible to make those decisions. There's more and more data that's being made available, but that's also a learning journey that most leaders are on these days.
I'm interested, as we look to the future, the next 5 to 10 years, what are some of the factors that you think, or trends, however you wish to frame it, that will help or hinder any increased focus on resilience within our financial system?
So I'm going to say something that is probably going to sound very boring. And it is part of the book, but I'm not sure that it is the part that, people really pay attention to because there aren't so many exciting stories wrapped around that point. But that has to do with organizational change. There's so much of the focus that is around, new investment products and new funds and new ways of, putting money to work. That's very captivating because it's interesting, it's exciting. But the other side of it has to do with the institutions that are responsible for selling these products. They're responsible for structuring these products. And if there isn't a deeper commitment from those organizations towards long-term value creation. If they think this is just something here and now and let's do a light touch effort and then move on, if it isn't embedded into the DNA of those organizations, then we're not going to see the results in the financial markets that we should be seeing. And it's challenging. I mean, there are two examples that we do have in the book where when we raise the question of, what does it take? How did you get so far? The answer is around, well, it requires true cultural transformation. And it's hard to figure out how to do cultural transformation, but one of the ones interviews that we did was with APG, a Dutch asset management firm. And the managing director we asked, so what was the journey like? And said from the time they hired the first responsible investment professional, which was in 2007 till now, it's been a true cultural transformation. It's about taking every single part of the organization and embedding this way of thinking. It's about understanding that this is important. It's a similar thing that was where the former CEO of GPIF was quoted, where he said, as he reflected back on the challenges that he had faced with the big reform and how he brought the organization along, what he mentioned was it was around how to make everybody think about this as being important to the business. It was about thinking about environmental factors. It was about caring about society. So as I think, towards the future and what is really going to determine whether things work out the way we want them to, it is if we are able to really drive that change on the organizational side, I think we'll be successful. If it ends up being something that's not really embedded into the organizations, I think we're going to see lots more challenges coming up and not the impact that we'd like to have.
It's such an interesting answer, and it reminds me of other change management or transformation efforts related to, for example, quality. So Toyota, incentivizing people on the shop floor to come up with ideas on how to increase the efficiency of processes, improve safety, improve quality, knowing that within the C-suite, we're not going to have the experience necessarily to identify all of the opportunities. I mean, we could probably go on this topic for ages, but it seems that there are playbooks that the sustainability or impact movement can draw on. It's just a different topic for increasing a cultural understanding and then transformation around a particular topic.
And I think you're right, Jen. I mean, incentives are a big part of the equation. I'll just briefly share a conversation I had while I was still at the Rockefeller Foundation and at this meeting with quite a few people in the room. And we were thinking about grant funding a product that was a variation of a municipal bond, and was around how do you do something that could drive more money towards green infrastructure, and you do it using the municipal bond, which is a pretty big market, right? Municipal bond structure, but with some variation to it. And it was very exciting. It was like, well, we could do this and we could do that, and this would work. And, let's look at that example. And there was a gentleman in the room who worked at the municipal finance desk of one of the big banks. And he asked a very simple question. And he said, but why would I do this? And I was like, well, there are lots of different reasons for why. And he said, well, I have no issues right now placing the debt in the market the way it is structured, and I get paid for it. And he said, so why would I start to do things this way, or why would I push for this? And a lot of that goes back to incentives. So how do you then adjust the incentive models so that you have people thinking about the long term?
Absolutely. And in terms of putting some of the ideas into action, if you're a portfolio manager and you are looking to lead in your offering related to ESG, what are some of the principles that they could put into action tomorrow morning, to get started? Like, what are some of the questions they should be asking themselves, or what are some of the tips from the book that they could apply?
So there's a message that kind of runs throughout the entire book that has to do with collaboration. It has to do with reaching across those sector boundaries. And if you do work in the investment management world, talking to the organizations like the nonprofits or other civil society organizations that have deep understanding of the sustainability challenges of those sectors, right? I mean, if you are a portfolio manager or any other role in an investment management firm or any other big organization, you cannot be expected to know everything there is to know about racial justice or environmental degradation or early childhood education. I mean, or gender equality, right? There's some things you can quickly try to read up on, but if you're really interested in making an impact, then reaching across that boundary and sitting down with a lot of these organizations that now are very, very keen to engage with capital market players and getting a way to learn from their experience, their thinking, their expertise, their networks. Those are the ones that are on the ground trying to make change happen every single day. And then figuring out how do you create investment products that reflect all of that knowledge and can bring those networks to bear, I think is a really interesting way forward, instead of just looking to public equities and saying, okay, I'll take a basket of 20 companies that are performing well in these 5 criteria, which is the easy thing to do.
Mm-hmm. A more multidisciplinary approach to maybe innovate a little bit related to ESG factors.
I mean, one of the things, and it's a short example in the book as well, as around, so ESG ETFs, exchange traded funds, are the rage right now. Everybody has one. They're growing. It's the easy way to even step into the impact space or the ESG space. One of the interesting ones that I think are out in the marketplace are ones where Impact Shares, which is a manager, partnered with NAACP here in the US. So NAACP is a civil society organization that has been on the forefront of racial justice, social justice for a very, very long time. They've been out in the communities, have had massive impact over the years. And what they did was, instead of themselves coming up, Impact Shares, and saying, these are the criteria that I'm going to use, they worked with NAACP and said, tell us what good practice looks like when it comes to racial justice and social justice, based on the experience that you have, not just in society at large, but working with large organizations over time as well. And then work with the organizations, work with the companies that we include in this fund to help them improve on those dimensions over time. So it's not just a static picture, but there is a way of continued engagement and improvement too. And I think, they've performed well, they have been growing. They're of course not as large as any of the BlackRock ESG ETFs, but it's a truly fascinating way of having impact and putting a new product out there.
I wanted to close with the following question. It's probably one of the trickier questions that I have for you, Saadia. And that is, it relates to ideas with enduring relevance for you. So if you had to choose just one book or idea that's played an especially significant role in shaping your perspective and the way you work, what would that book or idea be?
So it's not so much a book. It is more a way of working. What I realized, particularly when I joined the Rockefeller Foundation, is it's very hard to figure out what the right answers are. The world is complex, the challenges are complex. So there is a way and a need to constantly challenge yourself and your thinking that you need to have in place. And that requires having people around you that challenge you as well, and having people around you that don't have the exact same perspective, that can lead to healthy conversations and new ways of thinking. So it's more a way of working for me, and a way of how do you get to better results, more than an idea per se from a book.
And it also links to your point about reaching outside of your field necessarily to come up with solutions, and maybe avoid a bit of groupthink too. I think that's a wonderful answer. Well, Saadia, thank you so much for joining us on The Future in Sound. I've really enjoyed this conversation.
It's been wonderful. Thank you so much.
Thank you to Saadia Madsbjerg for joining us. You can learn more about her work and recent book, Making Money Moral, by checking out the links in the episode description, or by visiting re.co.com/The Future in Sound. The Future in Sound podcast is written and hosted by Jen Wilson and produced by Chris Attaway. This podcast is brought to you by Rico, a market intelligence company helping clients achieve resilient competitive advantage in the long term. If you enjoyed this podcast, don't forget to tell a friend about it. And if you have a moment, rate us in your podcast app. Until next time, thanks for listening.